You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 9th of May 2024, and I'm joined by my co-host John McEwen. And in this week's episode, we'll be discussing Boohoo, Unilever, RELX, Nestle, ABF, and our US company of the week is PepsiCo. John, should we start with tears for Boohoo?
I suppose so, if we have to.
We do. So we'll get it out of the way first. We'll have our vegetables. So Boohoo, which we both own, unfortunately, have come out with their full year results, and revenue declined 17% to 1.5 billion, ignoring exchange rate impacts. Revenue fell across all regions, including an 18% decline in the US. Active customer numbers were down 11% to 16 million. So in terms of revenue, dropped very similar to ASOS, which we covered a couple of weeks ago. Underlying operating profit fell from 6.5 million to a loss of 18 million, driven by a fall in sales and reduced prices. Net debt increased to 95 million from 5.9 million of net cash. Free cash flow after tax worsened from an inflow of 30.7 million to an outflow of 63 million, in part due to inventory levels rising to support the opening of a US distribution centre. The group expects to achieve positive free cash flow and deliver annual cost savings of 125 million in the 2025 financial year. The group remain confident in its 6 to 8% underlying cash profit main target over the medium term. The shares fell 5.7% in early trading. The 125 million of cost savings will be reinvested to keep prices low. And one of the big issues they've got is that they spent very heavily on increased capacity, and particularly in the US, where revenue's down 18%. On the positive side, if there is one, the new marketplace offering allows third-party sales on the Debenhams website, and the commission-only model generates less revenue, but it's higher margin, so maybe that'll help a little bit. In terms of valuation, the business trades at a forward price-to-sales ratio of 0.29, and that compares to a 10-year average of 1.97. There's no dividend, and the market cap is 433 million compared to the 95 million of net debt. Obviously, these results are very disappointing. We did talk about the ASOS results and said if they're similar, well, I'd probably consider selling. They are pretty similar in terms of the revenue decline. I don't think the debt's quite as bad yet, but it's ramping up fast, although that is partly due to inventory levels rising to support the US distribution center. Probably my main concern with this, I think the cost savings are good. I do question how much bloat there was in the business if they can just slash 125 million of costs that easily. But my main concern is that they've invested heavily in the US. I feel like we gave them a couple of years grace in terms of that. So when they were having issues with shipping, they were having to fly in the stock, we were kind of saying, well, if they can crack the US and they believe that that investment will be rewarded, it's probably forgivable and a temporary problem. I think a lot of those problems have gone away and they're losing revenue in the US whilst expanding capacity. I think they're only expanding capacity because they've basically had already committed to it so heavily. Yeah, I'm just not really sure whether that capacity is now going to be needed. They should be growing in the US, really, and that's probably my major concern. So I'm not sure what to do with this one. What about you, John, as a fellow sufferer?
Well, there is little positive to see in it. It's perhaps not quite as bad as ASOS is, but it's going in that direction. And I agree, it made complete sense for them to build the US distribution up and invest that money because demand was outstripping supply and it would be the logical thing to do. But you're seeing US customers decline, or revenue in the US decline by 18%, and customer numbers down 11%. It's really bad. You see the Chinese competitors coming in, and I suppose a move towards more of your Vinted and your Depop's. It's very difficult to see Boohoo and ASOS turning around, and you do make a very valid point about whether it's wise to continue to hold the stocks. I suppose you get into that sort of, you lost so much, at what point do you sell? But it can go down to zero. So if you're not seeing the investment case now, maybe it is better to call time on the stock.
I mean, we did talk about it a couple of weeks ago with ASOS, where we'd drawn comparisons to my Debenhams investment and how I sold it. Must have been at least 50% loss, maybe even higher. Probably one of the best decisions I made because it went down to zero. Now, inadvertently, I've actually ended up owning Debenhams again, which is not a position I ever wanted to find myself in. But I'm just kind of
Was that
thinking,
not a red flag for you, Sam?
it probably should have been, but I mean, it was down so much at that point. I don't think it's increased my losses.
Yeah. And Mike Ashley, now the largest single shareholder, I think he owns more than the founder. I think he's got about 20% of Boohoo, possibly more.
I mean, maybe it can turn it around, but I thought they were going through a bit of a wobble. I didn't think it was such a major turnaround when I bought it.
Yeah.
I kind of thought they just got ahead of themselves with the pandemic growth and it would catch up after a year or two, and that just hasn't happened. It looks to have been the start of a decline. Maybe they can turn it around and investors will do really well and sort of 10x their money if it gets back to previous levels. But it's every time results come out, I'm just filled with dread.
Yeah, no, I agree. And
But
we've seen quite a few bad sets now, and there's no sign of it getting any better. And I know that when we looked at it first, they had a lot of cash on the balance sheet, and that's soon disappeared.
So I'm kind of thinking it might be best to just part ways with it because there's no way I'd buy it today.
Yeah, no. Well,
and
watch this space.
30% of what I originally invested is definitely better than zero.
Yeah. Difficult pill to swallow, though, isn't it?
It is, but yeah, it is what it is. Should we move on to something more positive?
Yes. Well, no, it is. So Unilever, which is a favourite of the show, it's one of my stocks, and it's come out with its Q1 trading statement. So for anyone who doesn't know, Unilever, it owns a lot of the brands that you'll probably have in your household, from Dove soap, Sure deodorants. It used to have sort of spreads and teas, but it's moved out of that, focused more in recent years on personal care. But yeah, lots of household brands that you'll have are Unilever. Got the whole list obviously on their investor relation page on their website. But anyway, Q1's trading statement came out with first quarter revenue of 15 billion euros, which was reflecting underlying sales growth of 4.4%, which was well ahead of market expectations. And revenues were driven by a mix of volume and price growth, both increasing by 2.2%. Growth was led by the group's larger billion-plus euro brands, which saw 6.1% underlying sales growth. The sales of Dove and Sunsilk contributed to the particularly strong performances in the beauty and wellbeing divisions and personal care. Unilever remains on track to achieve full-year targets of underlying sales growth of between 3 and 5%. And the board has maintained a quarterly dividend of 42 cents a share, and the shares were up nearly 5% in early trading. In terms of valuation, Unilever has a market cap of £106 billion and trades at 16.5 times forward earnings, with a prospective dividend yield of 4%. I thought these results, or this trading statement, was pretty good. I think it's getting back to sustained growth, and also that you're seeing volumes rising too, because there've been significant price hikes over the last couple of years, which they have been able to pass on, but you were seeing volumes falling as a result. Now, perhaps with the easing of the cost of living pressures and a more focused approach from Unilever, you're seeing that going in the right direction again. It is maybe a little bit lackluster with how they're guiding, with between 3 and 5%, but given how it's been in recent years, that's not necessarily a terrible thing. I think you would hope that with the divisions, particularly in the emerging markets, that you might see that getting into the higher single digits, but that is a long way to go. And I think you'd probably argue that it's fairly early on in the turnaround as well. There are talks about spinning out the ice cream business, and that's, again, slower growth when you're comparing it with sort of personal care and beauty and well-being. Appreciate when we had Flosser on the show a little while back, he wasn't sure about spinning out some of these more sort of legacy and lower growth divisions. I think shareholders will just have separate shares in that ice cream business as opposed to just selling it off completely and taking the cash in that sense. I'm happier holding Unilever now than I have been for a fair while. And I don't think the valuation is outrageous at the moment. I think it's, increasing with a view that the market is expecting it to continue with the progress that they've made. It's still cheaper than Nestle, which we're going to come on to, which is significant. Well, it is more expensive and they've been struggling of late. But no, I don't think you can go too far wrong with a stalwart like Unilever in the portfolio. And hopefully with this new chief executive, they can continue in the right direction.
I largely agree. I think the volume increase is obviously very welcome, given that it had started to decline, but like you say, on the back of some quite big price hikes. I think the focus on the €1 billion plus brands seems to be working, with those growing 6.1%. I probably would be against spinning off the ice cream business. I think, yes, it's slower growth at the minute, but I think Ben & Jerry's in particular is a, fantastic brand. And a lot of these €1 billion plus brands are going to go through periods of higher and lower growth. So I think having a diversified portfolio of them, I think really the main thing should be the quality of the brand. And I think in terms of quality, Ben & Jerry's does tick that box. I agree it's not massively expensive, especially given that it does seem to be turning around compared to what we were used to seeing a couple of years ago with the previous management. So yeah, I think it's a good set of results.
Very good. On to RELX.
Yes, so RELX, business we have covered before. So they are a leading data solutions provider, and they operate across 4 main segments: risk, legal, exhibitions, and scientific, and medical and technical. I do deal with them quite a bit at work. So one of the companies they have is Tolly's, who do a lot of basically tax subscription services for professionals. So like the industry magazine that I read is a Tolly's magazine. Some of the materials that I learn for certain taxes is Tolly's materials. Very, very well respected in the industry. I know they're also in law and other industries, but based on what I've seen in accounting and taxation, top quality. They have released a trading statement and they've reported a strong start to the year as they continue to transition towards higher growth analytics and decision tools. There was broad-based growth across all categories. The largest segment, risk, saw strong underlying revenue growth, which continued to be led by financial crime and compliance and digital fraud and identity solutions. RELX has confirmed its full-year guidance for strong underlying revenue growth across all categories, with underlying operating profit growth slightly exceeding underlying revenue growth, and the shares fell 1% on the announcement. So 83% of the revenue comes from digital products, and over 50% of the revenue is recurring subscriptions. Last year, they returned over 800 million buying back shares, and the plan is to buy back 1 billion over 2024. In terms of valuation, the business trades at a forward PE of 26, and that compares to a 10-year average of 20. The prospective yield in the next 12 months is 2.5, and that compares to a 10-year average of 2. I'll just check the market cap. The market cap 64 billion, so those buybacks aren't really massive. I think this is a great business. They've not really given us loads in the trading statement, but I guess if things are going well, they do like to release a trading statement just to come out and tell us, even though they've not really given any figures. But really, really good business based on what I've seen in the industry I work in. Very, very high quality product, very, very sticky. I just don't think, when you look at the growth over the last 5 years, it's decent, but it's nothing to write home about. I think a forward PE of 26 is quite expensive. Maybe if you think that with the recurring revenue, it's worth paying more for with the move to higher margin services. But I think I would like to own it. So I actually have added this to my watch list on the back of looking at it for a second time here. But it would have to come down significantly in price, or the growth would have to go up significantly for me to pay 26 times earnings for a £60 billion company. John, what do you think?
No, similarly, I think it would be a bit expensive for me. It does sound high quality though. Less familiar with it in sort of work day to day, but I think it would be a game one I do a bit more research on and probably watch.
Yeah, so probably come back in 6 to 12 months and hopefully it's dropped.
Yeah, fingers crossed.
Should we move on to another business that you're hoping to see drop at some point?
Well, absolutely, and it has been dropping actually. So this is Nestle, which historically, when we've been covering it, has traded at a significantly higher valuation to Unilever. And for good reason, the fundamentals have been much stronger with it. Anyway, they've also come out with a trading statement for the first quarter, and the group's first quarter sales reached 22.1 billion francs, which reflected organic growth of 1.4%. And that was behind market expectations, as a 3.4% increase in average selling prices was offset by a 2% drop in real internal growth, which fell by more than was anticipated. In terms of the geography, organic growth was driven by Europe and the emerging markets, and there was softer demand and supply chain issues in North America, which is Nestle's largest market, which led to a 2.5% decline in organic sales. There's a mixed performance across product categories, and supply constraints hampered the sales of Nestle's health science segment, whilst pet care stood out as the most significant contributor. And interestingly, e-commerce sales grew by 6.1%, reaching 17.4% of total group sales. Nestle has confirmed its full year guidance for organic sales growth of around 4% and a moderate increase in underlying operating profit margins. And the shares were down 3.3% after the announcement. In terms of valuation, Nestle has a market cap of 246 billion Swiss francs and trades at 18.3 times forward earnings, compared with a 10-year average of 21.6, and it has a prospective dividend yield of 3.4%. I think for Nestle, these results are very disappointing. It has been beating Unilever, Reckitt, and Kraft Heinz, its major competitors, quite significantly over the last few years. And now things are stuttering. I think it's not the first time that we've seen it, but it's becoming a bit of a trend, and it has been behind where the market expects it to be, with some of those really leading brands like Nescafe and Nespresso, for example. In terms of going forward, it is guiding similar to Unilever, but I think the difference really is what the market has expected and the premium that it trades at over it. In terms of brands, perhaps Nestle is slightly better than Unilever, but I wouldn't say it's significantly better, but it has been doing it's been achieving a lot more with those brands than Unilever has been doing in the last few years. So if I were looking at them, obviously I'm biased, but I probably would be sticking with Unilever. I think for the valuation that it has, I think the turnaround and the momentum is probably with them, and it is a bit cheaper when it comes to valuation. So I'd probably be still biased towards Unilever, especially after this. And the fact that the valuation has come down a bit with Nestle, it's probably not enough for me to be looking at buying shares in it just at the moment. But it is a business that at some point I would quite like to own and have in the portfolio. Sam, what are your thoughts on this Q1 trading statement?
Slightly disappointing. Obviously, they've raised the prices more than Unilever, but then they've been punished with the volumes. But it's the cheapest we've seen it at a forward P of 18. Now, I still think it's quite expensive for a business that's probably going to grow at best mid-single digits every year. And the yield's a bit lower than Unilever's, but it's starting to look more attractive. I know you're saying you'd stick with Unilever and you'd like to own it. I'd imagine it's not too far off the price at which you would actually be interested. Like if we came back and it dropped another 15-20% and it was at a P of 15-16.
Yeah. I think you'd be right there. I think you would be right there. So it's on the watch list, but it's quite high up on the watch list now.
Yeah, it's not. I don't think it's quite there yet, but it's getting there. I think 15-16 is probably quite a fair price for such high quality brands. But yeah, disappointing in terms of the volumes, but yeah, they did raise prices slightly more than Unilever, so I think that is a risky take. But should we move on to another quality business?
Yeah, absolutely. So next up we have ABF, Associated British Foods.
Correct. So mainly known as the owner of Primark, although it is a very well diversified business, which we've covered in the past. So they have come out with their interim results, and revenue rose 2% to 9.7 billion in the first half. This reflected growth in all business segments except for agriculture, which experienced an 11% decline. On a like-for-like basis, Primark sales grew by 2.1%, primarily due to higher average selling prices. Underlying operating profits rose 39% to 951 million. This was driven by robust margin recovery and improved operational performance. Free cash flows improved from an outflow of 510 million to an inflow of 468 as inventory levels normalized at Primark. Net debt was down from 2.6 to 2.5 billion. ABF now anticipates achieving significant growth in both profitability and cash generation, surpassing expectations set at the beginning of the financial year. An interim dividend of 20.7p was declared, marking a 46% increase from the previous year, and the shares rose 7.2% following the announcement. Also, first half sales in the US, where Primark has been expanding, grew 38.4%, and carefully managed click and collect trials have given management the confidence to expand the service at Primark, which I think is probably the best way of doing it because they don't really want the delivery costs. Including lease liabilities, as mentioned, the net debt is 2.5 billion, but that compares to forecasted cash profits of 2.8, so it's not really a concerning level and it's well below the target. In terms of the valuation, the business trades at a forward P of 13.4, and that compares to a 10-year average of 19.4. And the prospective yield over the next 12 months is 2.6 compared to an average of 2. I think this is an excellent set of results. I think operationally they've done very well. I know the revenue growth's not spectacular. I think the main thing as well, just tucked away in there, is that 38% growth in the US. It does show that obviously they're, if done properly, a retailer can expand in the US. Although I think Primark have gone about it in a much more sensible way. They've been quite slow expanding the stores. They've not overinvested in capacity like some of the other businesses we may have covered in recent weeks who will remain nameless. But yeah, I think really good set of results, and it's not that expensive, especially when you consider that it's still not priced as if the US has to be a major success. If the US just completely flops, you could buy this at 13 and still do very well. So I really, really like it. John, I know it's a business you've looked at very seriously in the past but never quite bought. What do you think?
Well, obviously, a feeling of regret, Sam, but I think it's doing very well. And like you say, it's still really tempting because the signs from the US are good, and it's not priced like it at all. And it's not like, for example, a Fever Tree is priced that it is going to crack and dominate the US. This isn't, and like you say, it takes a lot of the risk away, but there's still a load of upside right there. So it's very tempting indeed.
What would it take for you to actually buy some?
It's not going to get any cheaper, I don't think. And especially if you're going in the direction that you wish it to be going in as a long-term investor, there's probably not much more that it could be doing, to be honest. I think it is right up there.
As well, one of the other things in terms of the upside is, so we don't expect loads from Primark in the UK. Click and collect expanding as well. That could be very
Yeah.
profitable because they don't have to focus on the losing money on the delivery or anything, and they're leveraging that store base where they are just kind of everywhere already, so it's probably quite easy to go and collect them. So
Yeah.
yeah, that's potentially another lever as well. So what do you think?
Yeah.
Do you think it's fairly likely that you'd be a shareholder next time we cover it, or will you just be
It
regretting not
could,
buying again?
no. It could well be. I suppose if you're being a bit more bearish, they do have higher staff costs, and I suppose particularly in the UK, with the increase in the sort of, I suppose, minimum and living wage, if that's going up, further with a likely incoming Labour government, that might work against them, but they are very slick operationally. So it's difficult. I think it's got a lot more going for it than against it. So I could well be.
There might be room in your portfolio for a British retailer in the near future.
It
One
was,
out,
but
one in.
hopefully it'll. Yeah, well, exactly. Tesco's and of course Boohoo won. Well, in fact, both both fared quite badly. Although Tesco was a much better business when I sold it than when I bought it. But I have been burnt with a British retailer or two, as
Third time's
as
the
have
charm.
you. Hopefully, okay. Fine. Shall we finish off with perhaps the most high quality business of the week?
Yes, but
Discuss.
I think there's a discussion to be had there. But yeah, I'll keep quiet.
There is. I mean, probably with, in fact, I was going to say with the most iconic brands of the week, possibly debatable. Again, PepsiCo, which owns Pepsi and also owns snack businesses like Doritos. They had their first quarter results out with revenue growing by 2.7% on an organic basis, reaching $18.3 billion in the first quarter. This was driven entirely by higher prices as volumes declined by 2%. Underlying operating profit rose by 5% to $2.9 billion, ignoring the impact of exchange rates. This was helped by price hikes and cost-saving measures. Free cash outflows worsened from $1 billion to $1.6 billion, and net debt rose by $3.4 billion to $37.5 billion since the start of the year. Full year guidance has been reiterated, with revenue expected to grow by 4% on an organic basis, and the group expects to return around $8.2 billion of cash to shareholders this year through a combination of dividends and share buybacks. And on the results, the shares were broadly flat. In terms of valuation, PepsiCo has a market cap of $244 billion and trades at a forward price to earnings of 21.1, compared with a 10-year average of 21.7, and has a prospective dividend yield of 3.1%. I think for the valuation, these results were pretty lackluster, and again, disappointing to see that volumes declined. I like the business a lot, but I do think that for the valuation, you would be expecting more. I guess it is one of those classic sort of US versus UK. Obviously, it's an iconic brand and it has a lot in its stable, and including the snacks division. But still, I would be much more on the Unilever and even Nestle fence in that sense, because I think you've got very high quality brands there for significantly cheaper valuations. So that's probably where I would be leaving it. It would still stay on the watch list, absolutely. But I wouldn't be going in at the current valuation, I don't think. Sam, what are your thoughts on these first quarter results?
Pretty similar, not loads to say. I wouldn't really want to pay 21 times earnings for a business that's growing 2% a year and has such a large market cap and is so saturated. I just don't. Yeah, I wouldn't really look any further.
No, and I mean we have covered it, and they're not the same businesses, but obviously you got Daddy Coca-Cola over in the States, but then you do have Coca-Cola HBC, and you've got, I think I can't remember the exact name of it, but in South America. And they're perhaps slightly high growth plays on, a brand that you think of as incredibly saturated, but in those markets that are still emerging. So I think they're perhaps where we would be more interested in looking than, PepsiCo or, Daddy Coke, I think has been really, really impressive. But of course, it comes with that really toppy valuation for a brand that you do think of as generally fairly saturated, and certainly where it primarily operates in.
So of the 6 businesses then that we've covered, Boohoo, Unilever, RELX, Nestle, ABF and PepsiCo, which do you like the most and which do you like the least?
So the least is very easy, it's Boohoo. And what do I like the most? Probably Unilever, but ABF, particularly with its current valuation and the prospect in the States, and as you point out, what it's doing with click and collect, it's very tempting. It's a different type of business, but there's a lot going for it, and potentially when it comes to growth, there could be a lot there that's not baked into that share price.
I think for me, ABF probably edges it over some of the other businesses, although we've looked at, I think, 5 very high quality businesses this week, and Boohoo as well. But ABF, probably on valuation, that would get it for me. Least favourite, easily Boohoo, which frustratingly is the only one that I actually own, but that's life.
Fair enough. Okay. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.